Elliot, as you've heard, CPI coming in hot, markets getting crushed. Was this a deserved decline, or does it look overdone in your view?
No, Dan, we spoke last month before Jackson Hole, and I said equities need to be derated. I thought the 75 basis points hike in September by the Fed was not being reflected accurately by markets, and so I feel like markets have caught up to our view, and frankly, it's turning quite consensus. I think at this stage, a proper slowdown in the U.S. is baked in. I think there's a reflection that the Fed pivot that markets were hoping for is not going to arrive. There's nothing coming to the rescue here.
And I remember your view was that it seems as if investors perhaps got too comfortable and maybe overestimated the inflation down path. So what do you think this means for expectations around Fed tightening moving forward? Talk of a 100 basis point hike heating up.
Yeah, we won't get at 100. I think I stick to my 75 basis points view, and I think that's also the proper one. Obviously, the report was nasty that came out yesterday. But underneath the report, you see that the inflation is still very hot in those areas that are somewhat lagging. It's the front-running ones that, particularly energy and food, that obviously have cooled off, and that should trickle through. But frankly, the Fed's not only looking at inflation data, it's looking at economic activity data, and there you can already see a lot of the slowdown showing up. Flash PMIs, particularly in services, coming down a lot. The housing market coming down a lot and fast. And that's obviously going to affect household balance sheets, net worth, and consumer confidence, etc. So as a result, if you take a mix of kind of the growth inflation picture, you see that it's inflation is still a threat, but growth is weakening. So some of the demand is going to cool off. The demand-driven inflation is going to show up eventually. It's just going to take much longer, and that means the Fed has to be tighter than markets had expected, and that means risk assets have to be a little bit lower.
So the concern here is that rather than inflation having peaked, it appears as if inflation may be fully entrenched now in the US economy. You mentioned it's probably going to take longer before we see a moderation in inflation anytime soon. So how much longer specifically, and how much higher will rates need to go as a result?
I think it's not necessarily that the terminal rate will be that much higher. I think it's that the market expectation that there'll be a fairly quick pivot, a quick U-turn early next year once inflation really has come down. So we see CPI kind of around 6% by end of this year. So quite a bit lower than where it is today. So we do think there'll be a pretty sharp drop off. It's just that expectation that you'd eventually get a quick turnaround. On average, in previous recessions, the Fed needed 8 months from the last rate hike to the first rate cut. If you take out some of the more unusual moments, it historically is even longer than that. So if you apply that to, let's say, Q1 or late this year is the last Fed rate hike, there's no Fed pivot until probably the end of next year. And so it's more of a rates stay high once they've reached a plateau. And that is what markets have not fully adjusted to.